Well, welcome to Chapter 2. As you can see, Chapter 2 really deals with financial markets and institutions. What is a financial market? What are the different parties in the financial market? Is kind of really what the chapter is about. On this screen here, you will see that some of the bigger ways that capital is matched between savers and borrowers. The three main ways are direct transfers, where a saver and a borrower get together and negotiate a deal directly. Investment banks are banks that negotiate and help companies issue stocks and bond offerings for the first time. So if a company wants to go public and issue stocks or issue bonds, an investment bank will help them out with that process and help them sell the stocks and bonds to investors who are interested in investing in that company or lending money to that company. So investment banks are not banks that we would go to for a checking or savings account or a car loan or a home loan, but they're working more with corporations to place stock and bond offerings. Then financial intermediaries is basically everybody else, every other party to the financial markets, and we'll talk about who some of those are later on. So the capital allocation process is just that process of how suppliers and users of capital get together, and so that we have a well-functioning, a highly functional process where suppliers and users can get together and easily exchange funds with each other. So individuals who want to invest and grow their savings can find ways to do that, invest it in something to grow. And then companies or individuals who need to borrow to seek investment for something in terms of growing a company or a patent or a corporation that needs additional funds to grow, whatever that might be, that those two groups have a way to get together efficiently, continuously, and where the users and suppliers are brought together in one place. So it's just like a market. So clearly the grocery store is a market. We know if we go there what we're going to get. With a grocery store, a lot of things can be bought online. We can physically go to the store. Kind of the same thing with financial markets. You can clearly go to your bank or go to an investment bank and have that meeting and establish relationships and find buyers and users can match each other up. It can also be done online. It can be done over the phone. No different than practically any other market, but it's just a place or that process of capital being exchanged between users and suppliers of capital. So there's lots of types of financial markets, and you can see a physical asset versus a financial asset being the first one. So a lot of financial assets, of course, don't really have a physical form. They're evidenced more by a contract or a certificate, like a stock or a bond or a loan document. A physical asset would be, real estate, antiques, collectible art, anything that maybe would be invested in but has more of a physical form. Spot versus future really deals with timing. A spot market is where things are bought and sold on the spot, just within days typically. And a futures market is where something might be bought at a future date, maybe at a certain price. So a spot market would be a good example to use, where in our part of the country is agriculture, where a farmer may contract to deliver bushels of beans or corn at a certain price on a certain date. That would be a spot market a future market, because that deals with delivery sometime in the future. Spot is more right now. Money versus capital really deals with duration. A money market typically is where funds are borrowed or loaned for short periods, typically 1 year or less. Capital markets are then long-term markets, more than a year. Typically these are stocks and longer-term bonds. Primary versus secondary really deals with who's getting the money initially. So a primary market is when a company first is selling stocks or bonds in its company and they're trying to raise that money to come into the company the first time. That'd be primary. You'll hear the term IPO at some point, initial public offering. And that's the only time the company gets the proceeds of a stock offering. After that, Stocks are bought and sold on the secondary market, which is pretty much any stock exchange, the New York Stock Exchange, the NASDAQ. We'll talk more about those in the future. Then public versus private really deals with who are the parties involved with placing investments. Private markets, where basically the two parties are directly working with each other to negotiate, the deal. The buyer and the user and supplier of capital are just having that one-on-one. There's nobody else is involved. Public markets, basically, there's some kind of a standard contract to have some of that exchange happen. A bank would be an example of a public market because there's some kind of an exchange contract. Insurance companies, there's several examples of those. So financial markets are important because they facilitate the flow of capital from investors to the users of capital. Markets provide people who want to save with a way to get returns on their money. Clearly, that's why you might put your money in a bank, why you'd invest in the stock market, mutual funds, pensions, the list goes on. Whereas then institutions or higher wealth individuals who have plenty of capital available then are looking for ways to lend that money out and get interest, or to invest in new projects and get a return on their investment. So to have a good economy means you have to have well-functioning markets where the buyers, the users and suppliers of capital know how to find each other easily, and the exchange of funds can be happening efficiently and quickly. So highly developed economies, this will be happening on a day-to-day basis. A derivative is something whose value is derived from something else. Okay, derivatives can be used to hedge risk or reduce risk. Hedge can be kind of a confusing term because you have what's called a hedge fund, which is not necessarily being used to reduce risk. A hedge fund is just a private investment fund, or I should say a private investment company where somebody is running it, and people can put their money into a hedge fund and it gets invested by the company in various projects or companies and so on. But a hedge itself is a way to minimize or reduce risk. For an example of a hedge, I hate to use a gambling reference, but that's the one that seems to be able to relate to most people, is let's just say you made a $10 bet on a football game, and the star player for the team that you bet on to win goes down and gets injured, and you're fearful that you're going to lose your $10 because the best player on the team is not going to play the game. So if you want to reduce your risk, you could place a bet on the other team to win, and maybe for $10, so that you basically will wash. Or maybe, if you're depending on how much risk you want to take, you could just place the bet for $5 to say, okay, I've reduced my potential amount of loss that I will have. So those are examples, and you can buy securities whose value is based on something else, so that you could buy hedges to protect yourself against inflation, the loss of the dollar, stock market going up and down, and so on. So there's lots of things you can learn more about that. This class isn't really necessarily about learning about derivatives, but it's important to know what they are as in terms of how do we reduce risk, and risk is a big deal when it comes to this class. So risk is a part of derivatives. There's lots of financial institutions. You can see a big list there, including that one about hedge funds. Your book has a really good list in Chapter 2 of the different types of funds, or institutions, I should say, and gives a pretty good job at explaining what each one is in detail. I've mentioned investment banks, that they help corporations go public with stock offerings and also bond offerings. A commercial bank is probably more the banks that you and I are used to. If we want to go and get a car loan or a home loan, we're going to go down to our commercial bank and talk to them about that. Financial services corporations primarily deal with lending. There'll be a lot of lease companies who fall into that category, or companies that will factor receivables for businesses. They'll give them some money up front for their receivables, more or less. Pension funds are just like they sound. Pension funds, a lot of states have pension funds for government employees. South Dakota does, for example. So if you're a state employee or a city, county, municipal employee of any way, shape, or form, and that includes teachers, basically your retirement goes through the South Dakota Pension Fund. Mutual funds are a great way to invest for anybody. 401ks use mutual funds quite a bit. It's just basically a conglomeration of stocks that have a common purpose. So for example, you could buy a mutual fund that's specialized in blue chip companies or small companies or international companies or companies from a certain sector. There's actually more mutual fund choices than there are publicly traded companies in the country. An exchange traded fund, or called ETF, is a fund whose value is based on the value of a market. So for example, the S&P 500 is an index that measures the return on a portfolio of 500 stocks. And so if you wanted to match the return of the S&P 500, instead of owning one of each of the shares, the 500 shares of companies in the S&P 500, which is prohibitive for a lot of people, I could just buy one stock called the SPY, and that's whatever, if the market goes up, the value of my stock goes up, and vice versa. So it's just a good way to invest in the market, get the same returns as the market without having to invest in any one individual company. I mentioned what a hedge fund is, and private equity funds are fairly common with a hedge fund also, but the book has a very good list of what all of those are. And you'll find those mostly on pages 36 and 37. So I would just take a look at those and just make sure you've got a pretty good handle on what those are. I should give you an example of private equity too. Is I worked in insurance for quite a long time, and insurance companies have a lot of cash, so they're one of those institutions that have lots of money to invest. And quite often they did a lot of private placements with companies who wanted a mortgage or an investment of some sort for something. So instead of going through an intermediary, and the intermediary getting a cut of the deal, a percent or whatever it was, just by going directly between the two parties, you can kind of cut out some of the cost and make it just a little bit more efficient in the deal. So we'll talk about stock markets just a little bit. Some stock markets have a physical location. The one that does is the New York Stock Exchange, the NYSE. It physically is located in Manhattan. Sometimes you'll see in the news that a famous athlete or entertainment star or whoever will ring the opening bell. You know, it's kind of a privilege to do that. Typically, famous people of some sort get to do that. So there's a physical location where you do that. Then you have the NASDAQ, the North American Stock Dealers Automated Quotation System is what that stands for. And it's really just a bunch of servers in a room. It's a market that is a virtual market. You can go on the NASDAQ.com website. And some stocks trade on the New York Stock Exchange, some on the NASDAQ. A stock trades on just a market, not both of those. And the New York Stock Exchange typically is the really, really big companies. They've got some minimum requirements. The NASDAQ, it would be there are some really big companies on the NASDAQ too, but a lot of tech stocks you'll find on the NASDAQ. There's really, I mean, it's really a narrow difference between the two. Just one has a physical location and one does not. That's really about the only main difference. So stock market transactions, Apple Computer decides to issue additional stock with the assistance of an investment banker. An investor purchases some of the newly issued shares. So it's a primary market transaction or a secondary transaction. Because this is new stock, I mean, it's very common for corporations to issue additional classes of stock throughout time. Like it's common to have a Class A common, Class B common, Class C common, and so on. And just whenever you're issuing a new class of stock, even if you're already a corporation that's been around, that's considered to be primary because that's the only time the corporation actually gets the cash for that stock. They're selling it directly to some users. Or buyers, I should say, who want to own the stock. And then those buyers who own the shares can then sell it to somebody else through a secondary market, which would be the NASDAQ or the New York Stock Exchange and so on. So once the investor who bought the initial shares sells them to somebody else, now it's a secondary transaction. Apple does not get anything from that. So an IPO just stands for Initial Public Offering. It's when a company first goes public. So going public means now the public, the people, anybody who's willing to put some money in a trading account and buy stock of that company. So basically, anybody who's eligible to do that, which is practically the entire population, I think you just have to be 18 or older to do that. Once you go public and your stock is purchased by individuals or other institutions, after that, your stock is traded on the secondary market. Okay, so once you go public, you're now subject to a whole lot of regulation and reporting requirements. Hopefully everybody by now has heard of the SEC, the Securities and Exchange Commission, who then kind of oversees the financial markets. And so when you first go public, you'd have to do a whole lot of filings and registrations with the SEC just to be able to get the permission to sell your stock or your bonds. And then once you've gone public, you have to continuously report with the SEC on the quarter and then annually. And so because of that extra reporting, there's a lot more burden on the company in terms of the financial statements, the volume and the detail of financial statements, the amount of internal controls required. All those kinds of things come into play, which can really add a lot of cost to running your business. There's just a lot of regulation that goes with being a publicly traded company. This just shows you how the S&P 500 has done over the last about 68 to 2014, so pretty good time frame there, darn near 50 years. And you can see the number of years that have been positive have vastly outnumbered the years where it was negative. Now, the investment, if you own a stock, if you own stock in the market, generally what you'll discover is that on average you earn about 8% per year. Where people get really nervous, though, is you have the good years and the bad years, right? So you can see this clearly that there's a lot of years where the returns are just crazy, really, really good, or really, really bad. There's a number of years where they were pretty small. So the best way to think about the stock market is to think long term, is just to think, if I put money in now, if I just let it sit there, even though some years will go down and some years will go up, on average, I should get around 8% return. But those fluctuations are what get people nervous and scare them and all that good stuff. So stock quotes are really easy to look up. It says here Yahoo Finance, CNN Money, or MSN Money are 3 very reputable and easy to use websites. Just know that all stocks have a symbol. Twitter, for example, is TWTR. Apple is APL or APPL. I can't remember the top of my head. So it's, basically, if you go to a financial website, you just type in the name of the company, it will come up. The software, the websites are smart enough to know if I see the name of a company that I know what that stock symbol is, and you can look it up. And this is actually a slice of Yahoo Finance, which is the one that I use the most. And when you look up a stock, it'll tell you what was the price it closed for yesterday, what did it open for today, and is that higher or lower than it was previously. And you can see here when they did this one for Twitter, it went up, and this is from March of 15. The bid and ask is basically what people are willing to bid and ask for, and that difference of a penny is basically what the dealer, the maker of the market, gets. And so the dealer just gets a penny or two when that stock is sold, but it's the volume of those shares, which can be in the millions per day, that they're making money on. You can see also there that they talk about beta. We'll talk about that in future classes. The 1-year target estimate is analysts believe the price should be around 53 within a year. The earnings date is basically when was the last time they reported their earnings numbers. What's the 52-week range? What's the low and high been in the last year? Basically, the volume is the number of shares that are traded that day. The average volume in the last 3-month average is over 20 million shares. Market cap is 30.36 billion, and what that is the market price of the stock times the number of shares that are owned by the public. So the price times shares outstanding is what the market capitalization is. PE ratio is price to earnings. EPS is earnings per share. It's negative because they've never been profitable, and the dividend and yield is the yield on the dividends, but they don't pay dividends, and the PE ratio is negative because the company has not made money yet. So we'll talk more about those in the future, but I just get you started with them. And then stock market efficiency basically is, we talked a little bit about that in chapter 1 about a stock being in equilibrium, and I kind of mentioned it's kind of hard to know what that is because we have to know what the intrinsic value of a stock is. But ultimately, what they mean by market efficiency is it's safe to assume that all investors have all the information about a company. And you may have heard the term insider trading. Insider trading means just when somebody has information about a company that nobody else has, and they use that to make money on the stock. They buy it low and sell it high, or vice versa. You can actually flip that around and still make money too if you do it right. So a stock is in equilibrium when it's fairly priced. And it says that investors cannot beat the market except through good luck or better information, just by maybe doing your homework and just coming across information that's publicly known. You can access it, but maybe people aren't acting on when it comes to the stock price. This is very hard to do. Just know that large companies on the market that have been around for a long time, it says here it's highly efficient because many stock analysts who work for investment banks and brokerage firms will be analyzing these companies, and they also communicate very well with their investors. All publicly traded companies have investor relation departments, but the bigger companies have even better ones than small companies. Small companies are not followed by a lot of analysts, and they don't have a ton of contact with investors, and so typically their stock price can be more inefficient. And generally, if you get lucky in the market or make a lot of money in the market, it's because you kind of got into a small company that doesn't have much track record, and you bought it before it hit the big product or the big success or whatever it was, before it gained national recognition and began to grow. So that's hard to do. It's hard to find those companies. There are websites that kind of specialize in helping you find that information, but ultimately it's a guess, a little bit of gambling. But that's, if you're going to try to make money in the market, that would be the best way to do it. Implications of market efficiency, and just think about market efficiency, and you think about the power of a smartphone in your hand, iPhone or Droid or whatever you're using, and think about the volume of information that you can look up with that smartphone. As long as you've got the cellular Wi-Fi connection, you can find anything about any company that's publicly traded. There's many apps that you can just go, Yahoo Finance has an app, TD Ameritrade, any company that does stock market brokerage has their own apps where you can log in and find all kinds of information about a company. And the volume of trades is much higher than it used to be too, with the internet and smartphones, laptops. It's very easy to make a trade. You can make a trade from anywhere as long as you have a connection. You could be, camping or on a hike. As long as you've got a connection, you can make a trade or find information. So it's very hard to capitalize on information. An example they give here is, you hear in the news that a medical research company received FDA approval, it's the Food and Drug Administration, for a product. If the market's highly efficient, can you expect to take advantage of this information by buying the stock? And the answer is no, because by the time that becomes public, everybody is aware of it, and the stock price has already been impacted, good or bad, by that information. So it's really hard to know. Small investors, on the left-hand side it says, a small investor has been reading about a hot IPO scheduled to go public later in the week. She wants to buy as many shares as she can get her hands on, is planning to buy a lot of shares the first day since the stock begins trading. Would you advise her to do this? And the answer is probably not. There's a lot of risk in IPOs. That's when a company, especially when a company is initially going public for the first time ever, because it's really hard to know what will the market do with this company. Is it seen as a hot company that, at least when it's a really hot company, everybody wants the stock, the price shoots up right away. But after a little bit of history, after they've got a couple of years under the belt, if they're not delivering results, that stock price is going to come crashing down. Or technology can wipe it out. There's a company called Palm, Palm, that produced PDAs, personal data assistants, and that was before smartphones. That's what you used was a PDA. Well, Apple came along with the iPhone and killed Palm. They don't exist anymore because somebody came along with a better product. And Palm was a publicly traded company. It was worth a lot when it first came out because people believed that this is a great product, and it was at the time. It's just that Apple came out with something even better that could do a whole lot of other things that Palm never even considered. So you have to be very careful when it comes to an IPO. Generally, if you want to avoid risk, you would not purchase an IPO. There are some things to consider about why the market may not be efficient, and that primarily deals with people, the people in the market. None of us are rational beings. We think that we are, but do we always make the best decisions that are in the best interest of ourselves and our finances? The answer is no, we don't, because we react. The psychology behind investing. There's been a lot of studies done about the psychology of investing. Different people have different risk tolerances. A stockbroker friend of mine, he says his worst days are when the market takes a big dive. Maybe if it goes down 200 or 300 points, he knows he's going to get a bunch of phone calls from people saying, should I sell? Should I sell? Should I sell? His answer is always no, 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 because you're selling low. Don't do that. You should really be calling me when the market is high if you want to sell. And so he spends his day trying to talk people off the ledge. So you have to really be careful about that. And if people have had a big gain or loss, either way, that makes them think they're invincible, or that they think will go right for them, and they'll make decisions based on that. So the behaviors behind it means the market maybe isn't as efficient as it really could be, because the people, you and I, who are in the market, we're not necessarily rational beings. We think we are, but we're not. We've all made decisions that we regret. We've all made decisions that in the heat of the moment we wished we hadn't done. And as we step back and think about it more logically, we go, that was really dumb. I should not have done that. And so that applies to the markets and investing. Clearly, that applies to the market. So that was chapter 2. I should point out that at the end of every chapter, what you're going to find is, now chapter 2 isn't quite as heavy on some of the number crunching as other chapters, but what you'll find at the end of every chapter is there will be a series of questions, good review questions, good review terms. It's always good to review the terms. There's always like a self-test question and problems, and the solutions are in the appendix. It's just basically learning the definitions of all the key terms in the chapter. So it's always good to know what those are, and it's good to kind of just do a review of the questions at the end of every chapter. And as always, if you have